G'day, g'day. Hey guys, Ben Nash from Pivot Wealth, and today I'm going to be talking about the most common money mistakes made by millionaires. This is a sort of a curious question that I get from a lot of people. I think because we don't talk about our money, a lot of people think that everybody else has it so much more together than they do, but that there are, I suppose that the fact that we don't talk about it does sort of cover up a few of the mistakes that people make that ends up costing them a bunch of money. So today, what I'm going to do is cover some of the really painful money mistakes that I've seen people with a bunch of money make, so that you know what to look out for, and so that you can avoid that happening to you. So look, guys, before I jump into the content, I just please don't rush out and make any life-changing decisions based off the back of the conversation today. Strongly suggest you seek out personalized advice from someone preferably with a magnificent beard before taking any action on any of the stuff that we cover today. So the problem, guys, is that spending money makes us feel good. It's fun, but money buys pretty shiny things, and when we have more money, then we start our aspirations get bigger, and the shiny things we wanted that extra bit of shine, and that extra shine costs an extra few pennies. So it can be easy to fall in the trap of making some mistakes. And look, I blame those people that make those fancy magazines that you see at the airport, and the guy with the sullen look and the watch and stuff. And clearly the marketing machines push us to think that we should have more, or we should have all of these things. But it doesn't always line up with the best financial decision. So look, the opportunity is that when you have a good base behind you, a good base of assets, that getting things right means potentially building huge momentum. So the opportunity is to leverage that momentum to actually start driving results. So what I'm going to cover, today, I'm just going to go through a bunch of client stories and really just talk about some of the things that I've seen happen in the past, and where the people went wrong and what to look out for. So the first story that I've got here, I got this client that they worked for a tech company, made quite a lot of money with tech, through technology, through a company's share price sort of increasing in value, and sort of it was about $5 million or thereabouts, with a big tax bill attached to it, but a decent chunk of cash there. And what they did is that they wanted to buy a family home, sort of thinking about starting a family, and went to buy a place, and they ended up buying this really lovely place in the eastern suburbs of Sydney. About $1.7 million they spent on this place, and great place, lovely. But then they made, because they had this foundation of assets behind them, the money started making more money, and the share price increased, the holdings that were there, and that meant that there were more options on the table for them. And what they realized was that they actually wanted, while at one point, and this sounds really ridiculous to say, but $1.7 million in Sydney, that's in the eastern suburbs, is probably, maybe get you a decent-ish three-bedroom house or terrace or something like that. But it's not like you're buying a palace for that sort of money. And because they had this other money that was happening over here, that they realized that they wanted more house for that, for where they were at. And but the problem with that was, and they had the money there to do that, but the problem with that was that they've got this existing house, which is like $1.7 million now. A property at that sort of level is not a very good investment from an income perspective. So like what we find in the Sydney market in particular is when you get above the sort of $1.2 million mark, the rental return that you get on that property, if you were to use it as an investment, it ends up, it's not great from a percentage point of view. And to like, if you were to say rent out a $4 million or a $5 million home, the percentage return that you get is much lower than renting out an $800,000 home or $1 million property. So for properties up to about that $1.2 million range, the gross rental yield, so the total rent before expenses and strata and all that sort of stuff, is about 4% of a property value. So for a $1 million property, you should be able to rent that out for about $40,000 a year. But for a $2 million property, you don't rent that out for $80,000 a year. The yield starts to, what we call compress, the rental yield, starts to compress. So like I had these clients had a $7 million property and the rental yield was only about 1%. So because there's not a lot of people that want to rent $7 million homes. So when we looked at the numbers, what we realized was that they shouldn't have actually had, you know, that if they in a perfect world, they wouldn't have rented a property at that sort of, they wouldn't have sort of owned a property and rented it out at that sort of price point because of that return. But then on the flip side, selling the property, you know, that's an expensive exercise as well. They're going to pay 2% for sales costs to the real estate agent. They'd already paid like 5% in stamp duty and costs to get into the property. So that's the 2% out, 5% in, 7% on a $1.7 million property. That's like 120 grand almost. So expensive. Now they do have piles of cash to console themselves with, but still it's painful to burn $120,000 just because they hadn't really planned out their purchase the way that they probably should have in hindsight. So, and I think that's the lesson really in this situation, is that you don't want to, you know, at that level, when you're making such big decisions, that you should be really crunching your numbers, thinking ahead for the things, not just for that decision in isolation, but looking at your whole sort of plan and the roadmap and the pathway for you going forward. And that's going to lead you to make a decision that considers all of the potentials that could have happened, because it wouldn't have been too difficult to foresee that the assets that were behind them was going to put them put these people onto a path where they could have afforded a $2 or a $2.5 million home quite comfortably if they wanted to, but that they didn't. But yeah, so that if they had done that, then they probably wouldn't have bought that. Well, they wouldn't have bought that $1.7 million home. They would have either just kept renting for a bit, or they would have punched up and bought at that higher level. So the key here is get the numbers right at the start. The next clients the next client story that I had is working with these lovely clients. They got quite a lot of money. It's like 50 million bucks, basically. Thank you, mum and dad and grandma, for putting in that hard work a few generations ago. But a fair whack of cash, and they came to see us looking for some broad sort of strategic advice in terms of how to allocate their cash between, you know, investing in shares, investing in properties, investing in other sorts of investments, income investments, these sorts of things. And we ended up, they already had quite a large chunk of the money in property. About 30% of the money was invested in property already. In fact, these are the guys with that had the compressed rental yield on the property at that 1% level, and we decided in the end to allocate $10 million to an equities portfolio. Now, what these guys did was that we were talking about our approach to investing and went through and helped them sort of formulate what the strategy was on our side. But at the same time, because people with lots of money hang out with other people with lots of money, they were talking to their mates about stuff, and suggested that they have a conversation with a private wealth firm, which was under part of the Macquarie private banking sort of whatever. So they went and had a chat to these guys. They were talking to us, and they really came to us for strategic sort of allocation advice. So they were sort of clued us in as they were going through that process, and I was really quite interested in how it I suppose what the advice that they would get from someone under that private bank. And ultimately, they convinced them to allocate part of the $10 million that was to be allocated to shares and equity type investments. They placed with them, so $3 million worth basically. And they gave them some recommendations, helped them set up some investments, and then I was ready to throw down, and happy to have a bit of a competition with the asset allocation and the investments that we had set versus what they did. So I was really closely sort of following along. But when I got the portfolio, when I got the information on the investments that they'd suggested, it turns out that a lot of the investments that were there were in fact the same sorts of passive index investments that we typically advocate and that we had in fact recommended as part of their portfolio. But the difference was it came with this 1% asset management fee, which on $3 million is $30,000 a year. So they're paying a huge amount of money for really what was essentially the same, but with just a little bit of sexiness and some nicer sort of marketing brochures and shrimp cocktails at the investor nights or whatever. But for me, that's $30,000 probably not quite worth it. So I think that it's easy, and I suppose obviously those numbers are really big, but you can apply that in any context. The lesson here, I think, is that sometimes people go in for the things that sound really sexy and really interesting, but ultimately, my business coach has this saying that boring is profitable. And I think when it comes to money, that certainly holds true. So, when you get caught up in the sexiness and the excitement of investing, it can take away from some of the fundamentals, like the fees that you're paying, the performance that's there, the complexity of the investment, that can mean that you don't actually follow the things through to get results. So, I think that the lesson there is avoid that sexiness and stick to your fundamentals. The next story is another one about a young couple, young family. They had about $3.5 million in clear assets after tax. One of them worked for, in fact, both of them actually worked at one point for a tech company, and when they started the family, mum took time out of the workforce to raise a fam bam. They were looking at how to allocate the money that they had, and they basically got emotionally attached to properties in a price point around the $2.5 million mark, which, again, looking at Sydney property, that's probably $2.5 million is maybe a 4-bedroom place. You might get a cupboard in the hallway for that sort of price because you are sort of punching up a little bit. So a pretty nice house. And what happened was that when we did the planning and we did the numbers, and the numbers told us that if they were to go down that path, that basically they would end up with this really lovely home, because they've got the cash there to do it, really lovely home, but essentially that they would be forced to continue to work for really hard, or at least dad would be forced to continue to work really hard for an extended period of time, which they weren't, they didn't really want to do that, as nobody really does. And the other, they wouldn't have a lot of money left after the purchase. And so over time, and because the tech company had gone through a massive growth curve, and therefore there wasn't like huge, like more millions of dollars coming in the future, that it meant that when you looked at the proportion of their overall assets, including their home, it looked really, really great, like really big number. But when we took the home into consideration, that they really, most of their assets was tied up in their home, and therefore in the future that it's likely that they're really it's a suboptimal financial situation, because they've got this awesome home, but they don't have a lot of income. So therefore their standard of living, if they did want to pull the pin on their work at some point, would be heaps lower, because they don't have enough assets to create the same level of income to replace the income from work. So what happened with these guys, because we did do the plan, and the plan said all of these things, but they'd got themselves emotionally attached to the place, and they basically just forged on and pushed through and purchased a property anyway, knowing that was the case. And as a result, they could purchase a property because they had the money there, but they've had to sacrifice in, mum's going to have to go back to work sooner than anticipated, that there may not be quite as much money there for, keep the option open for private schooling if that's what they want to pursue. And again, they're just forced to work harder for longer, because they let their emotions get in the way. And I think that's the real lesson in this case, is that with property in particular, that it is really easy to let the emotion get caught up in the emotion of a purchase or some sort of property. And the emotion is important, but a great strategy is one that balances the emotion of a purchase with the financials of the purchase. And both are important, but ultimately, if your goal is to be successful with your money, to be financially free and to create an epic life, to create the freedom in your life because you've got the money behind you to do what you want, you need to prioritize the financial impact just as much as the emotional impact. So take the time to do your numbers, but then don't fight it, and you'll be best placed to get a better outcome when you make these bigger decisions. Another couple that we worked with, they had 3 kids, a household income about $500K, in their early 50s. They had a lovely home, couple of $1 million, not a huge mortgage, but a bit of a mortgage on there. And they had a bit of cash behind them as well. What happened with these guys is that they had they basically they promised their kids that they would send them to this fancy private school, and I don't know, like if they told their mates or whatever. Yeah, but they basically got themselves. I think that they felt that because they'd promised it to their kids. Not sure if there was a bit of social pressure there from other mates as well, but that they would do this. And we did the planning and crunched the numbers for them, and the numbers just didn't add up. When we added in $100,000 a year for schooling fees, you basically need to earn, because it was a sole income earning household, like it was just just one half of the couple that was earning that $500,000, that you basically immediately, your income is now $300,000, because you need to pay, because the top marginal tax rate is 50% essentially, to get $100,000 of after tax money to pay the school fees of $100,000, that you need that's 200,000, so which is immediately gone. So the remaining income is $300,000, and again, it seems a bit absurd, but the cost of living, paying down a mortgage, and actually then making sure that there's money aside to pay for, to invest for ultimately retirement, and trying to replace that, the income that you sort of gotten used to, it just doesn't leave very much money. But we did this strategy meeting and looked at that, and everyone was upset, mum's in tears, but they still went ahead and did it. And I think unfortunately it just means that you just have to work for longer. You just have to and in the future just make even bigger sacrifices to your lifestyle. And I think there's this concept called lifestyle smoothing, and it's essentially talks to the fact that the optimal strategy from a spending and saving point of view is that you're able to spend at the same level throughout your entire life, which means that while you're working and you need to be and building up your assets, that you need to be spending less than you earn so that you've got money for saving and investments. But then you're saving at a level that gives you the income so that you can continue spending at the same level. You don't. What I think is suboptimal is some people get really caught up and they're really guilty spenders, and they save all of this money, and then they've got this huge pile of cash that allows them to spend at a heaps higher level in the future. And you don't want to go on the other side, obviously, where you spend heaps of money and then in the future you don't have enough assets behind you to spend at the same level. So this lifestyle smoothing, these guys are living this rock star lifestyle now, but in the future it's going to be unless they want to work for forever, that they would need to save so much money to spend at that level. Otherwise they're sacrificing, and the lifestyle spend drops. So I think the lesson with this is avoid that lifestyle creep and social pressure, and ensure that when you're making bigger decisions, and particularly the decision around schooling, which can be crazy expensive, to make sure that does fit with your financial plan, and you're not sabotaging yourself to do that. Because to me, while it's great, and I've got a daughter at home, I want the best for her, but I don't think your kids would want you to sabotage your financial future so that they can have a better education. Another story was lovely couple in their 40s, 3 kids, household income about $750K, working tech, lovely home, about $3 million with a mortgage just under $1 million, and they were getting all these shares from their tech company that they work for, and then just plowing that cash into the mortgage, and they'd made some good progress, and obviously had a lovely house, but they didn't have any assets outside of their property. And they clearly had, got a $3 million house with a $1 million mortgage. So there's a ton of equity there. And I think it got sort of caught up in the busyness of life, and figured that, we're told that paying down debt is good, which it is. But they got so focused on that strategy that they hadn't been building any momentum in other areas. So the other thing was that they had, their banking was sort of all messed up, that they were paying this money into the mortgage and then getting these big tax bills and then taking it out. And because there's money going in, money going out, it was just frustrating. There's no clear number around the savings, like how much was actually being saved, how much are they spending, and that leads to a lack of motivation. Because if you can't see, you're making some progress, but you can't see the progress that you're making, it means that you're less likely to pursue it. Whereas I've found that having a dedicated savings account that you have separate just for your savings, and you can see that money building up each month, you get more and more motivated to save even more. Whereas, so you want to separate your savings from the savings that you want to spend and savings to save. So we tweaked with a few little tweaks to the banking like that. It meant that they were much more motivated to follow things through. And the other key mistake was that there's no tax efficiency in their strategy. There's no tax effective investments there, and paying hundreds of thousands of dollars every year in tax, but not assets not set up the right way. So I think that the lesson here, and this is not really a huge problem, but it's just a massive missed opportunity that we could have been using that equity, maybe invest in property, maybe invest in shares, maybe do a debt recycling strategy, and being smarter with tax while still getting the same outcomes from the debt side of things as well. And the last story, and this is for one client, but particularly it's a pretty common sort of one, with really strong household income, guys in their sort of 30s. They had just been busy with work, working hard to make good money, young family and stuff, and just end up just building up all this money in cash, and they build up close to $1 million just sitting there. And again, not a problem. Like, that's never a problem when you've got $1 million sitting in your bank account, but it just meant that they not tax efficient, had an investment property, fully offset, tax inefficient, assets in the wrong name. We had mum was on a slightly lower tax bracket, but assets in dad's name because he was the one that was more, involved in that stuff or interested in doing things. And I think that the lesson there is that you've just got to make the time to make this stuff happen. I think that it's not like something like that happens overnight. So, but I think people don't really know what to do. And it's this information overload. Is like you start to look at stuff and there's so many options and so many decisions. And because the decisions are big ones, that you don't want to do the wrong thing. So you end up doing nothing. And then time goes on and we're busy and life goes on, and we just missing opportunities to be getting your money actually working for you, which is the key thing that you need to do to be successful with your money. So I hope you found those stories helpful. I hope it can if it can save just a few people from making some of these mistakes, and that makes me happy. Look, the actions from here, guys, some of the lessons from here, do your numbers at the start. Before you go making any big decisions, do that. And obviously I'm biased because we do this sort of planning stuff every day, but making sure that you're staying on top of that at least sort of once a year-ish to refocus and make sure you're still doing the right things for what's going on with you right now. Let the numbers lead. What are the options, and don't let emotion get in the way, or at least balance the emotion with the financial side of things. Keep your assets, keep your financial, a couple of stories in there about lifestyle creep, keep your financial assets growing ahead of your lifestyle so that you've got more money to build your momentum. Avoiding the conflicted agendas and those sexy strategies that can be suboptimal and generally expensive. Boring is profitable here. Avoid the hype. Don't fall up. Don't fall into the trap of keeping up with the Joneses and that lifestyle creep. Outsource. If you've got a lot of money, just have a good team around you to do this. Obviously I'm biased as a financial advisor because this is the stuff that we do. But this is like I got fat, so I got a personal trainer, and then I can outsource at least some accountability to them. It's the same with my business coach. Keeps me accountable, there's a framework there. There's someone that's pushing me. If I get off track, they give me a whack, and they make sure that I'm doing the things that I'm supposed to be doing. I do the same thing with my mindset. I've got an amazing mindset coach, helps me keep my focus, keep my balance, and these sorts of things. And I think that you need a framework that works, because in the absence of a framework, you're just doing stuff. And when you're unsure if what you're doing is the right thing, it's really easy to just get off track, get distracted, and then you get shitty results as an outcome. So the results, if you do that, you can have more money, avoid frustration and stress, get ahead, and ultimately create financial freedom. This works because you put your strategy first, you're objectively looking at what's best, and you're leveraging the rules to your advantage, covering your bases and making sure that your risk is managed as well. The lessons here, money is about numbers. So let the numbers guide you, and you're going to be better placed to make better decisions. And ultimately, from here, make sure that you're taking action, being smart when you're making these calls, and running your numbers, getting some good help when it's needed. So guys, I hope you found that helpful. Any questions, hit me up. There's more resources and tools on the Pivot Wealth website, which you can check out at www.pivotwealth.com.au. Bye for now.